I am your host, Greg Weldon, with another episode of Money Markets and New Age Investing. And man, I have a lot to talk about today. I just have my choice from a plethora of really exciting things that in some ways are not so exciting. But let's start with the big news, Jerome Powell. Let's look at his comments directly. Let's go straight to the horse's mouth. Although, quote unquote, although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident. All right, that's number one. Number two, he's talking about, supply demand and working within the context of, bringing down inflation to whatever degree. He says that 2 months of good data, only the beginning. Okay, there is substantial further ground to cover to get back to price stability. And he's right. I mean, 3.2 is not 2%, unless you're willing to change your price inflation target, which I think is inevitable, but nowhere near term on the timeline horizon, not even close, but inevitable. There is substantial further ground to cover. All right. So again, it's a timeline thing again. Okay. When he talks about core goods prices are down, okay, but sustained progress is needed and restrictive monetary policy is called for to achieve that progress. Pretty hawkish, all right? The rebalancing of the labor market has continued but remains incomplete. Evidence that the tightness in the labor market no longer exists could call for a monetary response. In other words, if we don't see a rise in unemployment, we don't see job loss, we will continue to push, and that could become a reason we raise rates again. I mean, that's saying a lot, man. I mean, that's pretty hawkish. Holy mackerel. Talks about restrictive monetary policy will play an increasingly important role in terms of post-pandemic, normalization. I hate that word. Would require a period of below-trend economic growth. A period of below-trend economic growth. What is trend, first of all? Doesn't define it. And is negative qualify? I mean, so the consumer is already kind of crimped. We are attentive to signs the economy may not be cooling. And additional evidence of persistently above trend growth could put further progress on inflation at risk and warrant further tightening of monetary policy. He said the same thing twice in a very short period of time. All right. Now, here's where it gets a little funky. Here's where Jerome kind of loses me a little bit. And this is a guy that you'll love because he's genuine, and you love because he tells you what it is. He tells you what he's going to do. He tells you what he believes, and then he goes and does it. Has he made mistakes? He's very much made mistakes. But at the same time, he's right there. It's tough to, he puts it all on the chopping block every time. So I have a lot of admiration for that. But the Fed needs to be a beacon of confidence. And this is where he slips sometimes. And here's the comments. When he talks about, real interest rates are positive, all right, we see the stance of policy as restrictive, putting downward pressure on the economy, hiring, and inflation. And what that means is that when you talk about what is neutral and what is restrictive, that's where you start to kind of get the gray area. The Fed did years of work and published in 2018 over 300 pages of the new policy paradigm, which specifically, there were 11 white papers, 3 of them, I believe, because I read every one of them, every word, over 300 pages, that discussed what is neutral policy. And it was R-star. That was the new big catchphrase, R-star. Well, the Fed at the time determined, and of course, this is a moving target, understanding that, but not that much, really, that R-star for most G20 countries, certainly G7, was 50 basis points over the price of inflation. So if you're in deflation, you can have 0 rates. But if you are in inflation, and at the peak, let's use core PCE to be conservative, 7% year over year peak core PCE would mean a 7.5% Fed funds rate to be neutral. To be neutral. And this is where some of these countries overseas that have hiked rates to 11, 12, 15, 16%. This is why. all right, they actually have a higher neutral spread over inflation to reach neutral policy, I should say, a higher spread over inflation to meet a neutral policy. So Powell goes on, but we cannot identify with certainty what the neutral rate of interest, what is the neutral rate of interest? And I mean, so, you know, and then he goes, there's always uncertainty about the precise level of monetary policy restraint we should apply. So, I mean, the Fed's telling us we're not sure, you know? And then he goes on to say, these uncertainties, both old and new, complicate our task of balancing the risk of tightening too much against the risk of tightening too little. And we know that. Too much, inflation, you know, the economy collapses. Too little, the inflation takes off and the economy collapses. I mean, either way, it's the same end result. All right. The purchasing power of your money is going to be devalued one way or the other. All right. So then he goes on to say something that was really insightful and very, I really liked it, but there's no way the Fed chairman should be saying something like this. Excuse me for being a little judgmental here, in a key policy speech. We are, and here's the quote, we are navigating by the stars under cloudy skies. And it's true. That's absolutely 100% true. But that does not instill confidence, man. And I'm sorry, the Fed may be too transparent here. Powell, too transparent, wanting to be too clear. And that's a great comment if you're not the Fed chairman. All right. And then he goes on to say, we will proceed carefully as we decide whether to tighten further or hold. And so that's interesting because that's what got the headlines. And that's what got everyone excited. They're going to proceed carefully. Oh, it must mean this is a dovish, speech. No, this was one of the most hawkish speeches, really, I mean, gosh, in months, if not since even like maybe last July. And he had to get hawkish by Jackson Hole last August too, because he was too dovish last July, if you remember. And I think he's fearful of making that policy mistake. And that is what they're doing. Of course, this is always what I use when I do public speaking. Hopefully you don't ever go see me speak because you'll already know what the big chart is. But it's like, of course I want you to come see me speak if I'm in your area. But nonetheless, is Nick Wallenda walking across the Niagara Falls on a tightrope with a bouncing beam? This is inflation on one side, deflation on the other side. Don't tip too far or you will fall off. The thing about Nick Wallenda that makes him different from Jerome Powell is Nick Wallenda was able to reach the other side and, go home. Jerome Powell will be doing this for the rest of his tenure, back and forth, if he ever even makes it across, which is a very tenuous bet to begin with, all right? But then he goes on to say the last comment, all right? And I'll go back to what he had said just previous to this, so a little repetition, but hold off to the end. We will proceed carefully as we decide whether to tighten further, or instead, whether to hold the policy rate constant and await further data. So, and in that context, this means further data that would make us tighten again. There's no easing anywhere mentioned in here, anywhere, all right? And that is what gets really interesting about it. Because the market's reaction. So moving away from Powell's comments, what happened in the next, couple of hours in the market? Fixed income was really critical, all right? Really interesting reaction. The DEES 2024, i.e. end of next year, Fed funds forward rate, implied rate. In other words, what's the rate the market's betting that Fed funds will be the end of next year? 4.5%. It had been below 4.5% this entire time, meaning that from a current 5.5 at the top end, let's just use the top end, they would be cutting rates 100 basis points next year. The Fed doesn't want to see that in the forward market. They want that gone. Just like they wanted it gone from the 2023, and it was gone. And just like they wanted it gone from the June 24 contract, and it was gone. And now it's left to the DEES next year. They want to be restrictive for a prolonged period of time so they can be confident that inflation is not coming back. And if that means pain in the economy, and that means unemployment, and that means pain for the consumer, so be it. This is what they want. Powell has told us. Pain is the word he uses. Come on. This is where he's going. And he just reaffirmed that they're going to keep chugging along until something breaks. Fixed income market, the DEES 2024, Fed funds forward went above 4.5% for the first time ever in its contract history. All right. Now, is this a tell for the Fed? What does the Fed need to see the end of next year's Fed funds, forward rate get to make them confident that the market is with them? Because the market still does not believe the Fed will not be cutting rates next year. And of course, that's predicated upon they're going to break something and they're going to have to cut rates next year. So is this a market vote that the Fed's doing the right thing? Or is this a thing where the Fed wants to see that dynamic where the next year's Fed funds rate closes its negative gap to the actual Fed funds rate? Not by the Fed cutting rates, but by the market reassessing the hawkishness of Fed policy and help the Fed defeat inflation, theoretically, because frankly, I would tell you none of this matters at the end of the day. Because the question becomes, what if inflation comes back? Is the Fed willing to keep push into an election year? Are you kidding me right now? When the economy is already weakening? The political will to do that may not be there. This could all be a smokescreen and verbal intervention to ensure they don't have to hike rates again. But if inflation comes back, then what are they going to do? They said they would. Man, this is tough. You couldn't pay me enough to do this job. I admire these guys for trying to do it. And they do a great job even when they, F up. They really do. So, when I'm critical of them, I do it with, with a bit of a cringe, because I don't like to do that. But this is what I get paid to do. What do I think? People pay me to know what I think. I'm going to tell you what I think. I'm not going to mix words. It's Howard Cosell. I just remember as a kid reading Cosell by Cosell. I was a member of a book club, a sports book club. And that was just an impactful book on me because it's like telling it like it is. That's just what it is. All right, so let's get back to the fact that the long bond yield declined and the curve deepened its inversion. Now, does this mean the market is voting that the Fed is doing the right thing and is going to actually bring the economy into a recession? And that's the right thing to do. Well, I can tell you this. You also have a huge short position in the bond market right now. Open interest since 2021 is up like 40%. And most of that's from the short side. And you can see most of it's in the most recent decline in prices, rise in yields. All right. So what does this mean? All right. Is pricing in Fed success and on economy and unemployment? All right. The Fed is, and I did a piece recently called Captain Crunch, one of my favorite cereals when I was a teenager. All right. The Fed wants crunch. They want to crunch everything. They want a credit crunch. They want the labor market to be crunched. They want inflation to be crunched. They want commodities, food and energy to be crunched. All right. They want the consumer to be crunched because they want credit to be crunched. And it needs to happen. But the problem is it's so tenuous that if you even prick the bubble, the entire thing could implode. That's the problem for the Fed, walking across Niagara Falls on a tightrope. But then they come out and just recently Powell said wages are too high to be consistent with the 2% inflation target. Wages are negative still, and if inflation goes back up, they'll be even more negative. The consumer will be back under pressure. Credit card borrowings at a record, maxed out to whatever degree people say they're unwilling to borrow more or can't. All right. Same with the banks, unwilling or unable to lend more to the consumer. Majority of banks, especially small banks, so on and so on and so on. Things we talked about before. And what's especially crunched? The mortgage and housing market. Residential investment down. Mortgages, forget about it. Okay. New home sales are down, or existing home sales are down, and new home sales are up. So that's kind of interesting. Why is that? You say, well, new home sales are strong, and the home builders are skyrocketing, which they are, and we've been along them. The HHB been over our recommendations in our ETF playbook, and it's really helped us outperform. But the degree to which that dynamic, which hasn't happened as far back as I can find, but it means at least 20 years, it's for a variety of things, least of which is that you're talking about the price dynamic. The prices are the same. I mean, so new homes are almost always been more expensive. Now they're not, all right, because of the whole dynamic around the value of homes going up when you can build a new home and the price of lumber has come down from where it was. It's still pretty high nominally, but so on and so on and so forth. All right, so that's interesting, okay? But in terms of even that, there's cracks and there's crunching, all right? Because if we compare now to July of 2022, all right, new home sales, homes sold completed, 149,000 in actual numbers, not the seasonally adjusted annual rate. That is out of a total of 161,000 since July. 93% of the new homes sold were homes that are completed. Okay, the homes sold not started yet, down by 37,000 from last year, and the percentage of homes sold that are homes that have not yet been started. In other words, we're going to contract you to build you a home. Like the home builders get off on that, of course. and well, they should, is down from 24% a year ago to 13% and a decline overall. What does this all mean, Greg? Come on, tell me. That's a lot of seemingly mathematical mumbo jumbo, and it is, but this is what I love doing. Because what that tells us is very specifically that the pipeline is kind of dried up at a time when we need more homes. And prices are soaring. So the next time when the Fed eventually takes the foot off the brake, housing is going to skyrocket like we've never seen before, and shelter prices are going to go through the roof. This is why the Fed can't really stop inflation with just monetary policy. And the worst thing that could happen is they crunch the economy and prices keep going up. Then you have stagflation, which is the worst case scenario for the Fed. And that could happen, and I'll tell you why in about 10 minutes. But back to the crunch. We've talked about the credit crunch. We've talked about the labor. We've talked about inflation. All right, we've talked about the commodity dynamic with the base effect, with Saudi Arabia holding off 3.119 million barrels per day in crude oil output, just unused, when the deficit day by day is globally is 2.5 to 3 million because demand is still growing, and is growing when output is falling. It's simple supply demand right now. It's held in. The only reason crude oil is not $100 a barrel already is because Biden dumped 40% or more than 40% of our strategic petroleum reserves on the market. Had he not done that, dwindled our strategic supply by half, go hat in hand to Saudi Arabia unsuccessfully, and we're still at $80 a barrel. What a waste, man. What a terrible energy policy. And like I said, I think I said this in the last podcast. If I didn't, I'll tell you now. 2 weeks ago, the weekly imports of crude oil in the U.S. were the highest in 20 years. I mean, come on. We're at the behest of Saudi Arabia on this, all right? And Saudi Arabia is tied in with Iran and, of course, Russia and China. This is the problem. And now there's a new wrinkle. When you think energy price inflation, just when you think, like Jaws has been on, like repeatedly, and I've caught all 3 of the Jaws movies, and wow, what a decline from the number 1. I read the book when I was a kid at the beach. But it's interesting because, the sharks are kind of in the water here in terms of energy, all right? We have the base effect in gasoline and crude oil. It's going to push inflation higher. It's going to, just straight up, right? To the degree to which the other piece of the energy pie, we looked at the breakdown in wind and the breakdown in solar in terms of the stock market, all right? The least efficient forms of green energy, by the way. What's the most efficient? Yeah, nuclear. And guess what? Uranium prices are breaking out. Uh-oh. So Saudi Arabia and OPEC control crude oil. Guess who controls uranium? Russia and Kazakhstan produce almost half of the world's uranium. Russia's number 1 in the enrichment. Kazakhstan's number 1 globally in output. All right. And what's amazing about uranium is, by default, because, the green, clean energy people has never been about saving the planet. You can't save the planet. There's a 25,800-year cycle of deterioration that's going to take place for the next 900 years. The planet won't be habitable for human beings within a matter of a couple hundred years. So saving the planet's a bunch of bullshit. It's a cover to find an engine of global growth so we can support all the credit, because we don't have one. We don't have the Tigers anymore. We don't have, Clinton, and you had, budget balances and tech driving everything. Then it was trade, and then it was China. What's it now? It isn't. Everyone's kind of tapped out. China's tapped out. Consumers tapped out. Okay? So clean energy has been the thing. But the problem is it's not that efficient. You're trying to phase out gasoline too quickly, and you need more energy. You can't say, okay, California has to be all electric vehicles by a certain year, but we can't even provide enough electricity to power the houses all the time. Come on. How insane is that? I mean, you don't have to be a rocket scientist to figure out how really ignorant some of this stuff is. All right? But in the context of uranium and nuclear energy, shocking to find out, frankly. I did not realize that there are 92 nuclear reactors in the U.S., that 28 states have the biggest percentage of their energy needs met by nuclear energy. Not more than, I'm not saying it's more than half, I'm saying, but the percentages, that's the largest. 28 states. Think about that. That's amazing, man. All right. Now let's look at it further. From the demand side, here are the countries that are looking to either re-enable, change the law to enable, or increase their already existing nuclear power. India, Canada, Pakistan, Turkey, the US, the UK. Sweden is looking to triple their output of nuclear energy. Triple. All right. Now, Rosatom is a big producer and exporter of all kinds of stuff, uranium, okay, products and pieces and, whatever, the housings, like the infrastructure and the materials. All right. Last year, 2022, their exports were 2.2 billion worth. They expect in 10 years to be exporting 200 billion. Come on, that's 100-fold. 100-fold. Sweden going to triple. All right, let's take the case of France. France relies on Russian nuclear-provided, fueled power for 70% of their electricity. I think that's right. It sounds high now that I'm thinking about it, but I'm pretty sure that's correct. Okay, whatever it is, it's a majority. Okay, France just announced a 100 billion euro plan. They're going to build 3 new reactors on the site where there's one now. Okay, and in addition to the 100 billion euro they're going to raise, they're also getting loans from Russian banks. Rosatom is going to build these nuclear reactors. So France and Russia are in this big deal over nukes. At the same time, you're putting sanctions on them, right? So there's some fear a ship got seized or something happened with the uranium shipments out of Russia recently, where all of a sudden now there's a big cry and that maybe they're going to be a blockade, or could be sanctions, or could Russia say we're not going to send it to you anymore? Now that would potentially risk $200 billion worth of foreign currency revenue into the country. So that's not likely to happen. That is more of a mutually assured destruction than anything we have going on with China anymore. But in terms of the U.S. imports 12% of Russia's uranium. 12%. If we don't have that, if France doesn't have that, if India, if Pakistan, if Turkey, if the UK, if Sweden don't have that material, electricity prices soar. So you're talking about crude oil, OPEC, Saudi Arabia, and uranium, Russia and Kazakhstan. Do we see the picture here? Not only that, but they're increasingly more deals to provide uranium, natural gas, and crude oil to China at the expense of the West. Of course, China's behind all this. You know that, right? The insanity and the ironic nature of the fact that, we are basically sending weapons to the Ukraine to fight someone that we rely on their resources for our electricity. If they basically say we're not sending you anymore, and if OPEC cuts output when prices are high, okay, do you not understand that they really kind of control the sense of the future of inflation? No wonder it's so uncertain, Mr. Powell, because you're fighting a global war, a financial asset and resource/commodity, natural resource/commodity war. We're at war with the new axis of power, OPEC, China, and Russia, and they hold most of the cards right now. I hate to say that. I really do. It makes me cringe, cry, and really sad and really angry all at the same time. It's like a confluence of emotions that are tough to deal with sometimes. All right. Now, I just did a report on uranium. Happy to send it to you. Sales, SALES, at Weldon Online, WELDON, as in Nancy, online, all one word, weldononline.com. I'll give you the full uranium report. Just recently we're due now in what we call in a macro market minute. Okay. So that is daily topics, daily video. It's free. It's on YouTube. It's /user/Gregory Weldon, capital G, capital W, Gregory Weldon. It's for YouTube for the in a macro market minute. And we just did one on uranium, just did one on the Fed, just did one on China. All right, they're there. You can see them all. Okay. But in terms of back to the markets, now that our little advertisement's over, I didn't really mean to do it like that, but that's kind of funny. The commercial's done. What's interesting about, the movement in the fixed income market in the U.S. is that as the U.S. long end comes down, we're now seeing a reversal in the spread against European bond yields to where the U.S. yield premium is narrowing, meaning less of a premium to hold dollars, which would hurt the dollar normally. But what's happening? On Friday, the dollar rallied. Dollar's breaking out. The dollar's breaking out. But stocks, gold, commodities, oil, all rallied on Friday too. That's not normal. These are not normal correlations. And what's interesting about that is the gold adjusted value of the dollar is not breaking out. In other words, the dollar's rallying against like everything except gold. That's interesting. Why? Because the dollar's rallying against every other currency in the world. And these are anomalies in these correlations that are really intriguing, and you don't see them often. Okay. But it's kind of like when you do see them, you understand the Fed is still the central bank to the world. And this has happened everywhere. This has been global. Policy is tighter, way tighter than in the U.S. and other places. And I've detailed the places where the real policy rate is even higher than in the U.S., especially in Asia. All right, where they were really aggressive in Eastern Europe and raising rates. All right. But think about the places where they've raised rates really aggressively, where inflation has been really high, and the currency has exacerbated the inflation push by depreciating. I mean, there are people in a lot more, Mr. Powell's word, pain out there than in the U.S. We're so egocentrically focused on the U.S. here in the U.S. that we lose track sometime of what's happening around the world. All right? Many of these currencies are at record lows. Record lows. All right? Think about those places where, how much the cost of living has gone up and how much devaluation there has been in the purchasing power of your paper currency. We talked about Turkey a couple podcasts ago when they changed the minimum monthly wage allowed. And I did a study and looked at the average annual income, in Turkey in 2008 when the lira was like 1 versus now when it's 27, and it's pretty straightforward. It would be like in the U.S. going from in 2008 making 140 grand a year to now you're making $5,000 a year. Think about that. That's the purchasing power of the Turkish lira right there. From 140 grand a year income to 5,000 a year income. Think you can live on that? Yeah. That's the people in Turkey. All right, let's run through the currencies real quick. 2 swing OPEC producers, which is huge right now, given, the margins and what's going on politically. All right. 4.5 million barrels a day between them, now only producing 2 million because of the currency depreciation they've seen. Nigeria, dollar naira, up 603% since 2008. Naira's at a new low, just made a new low actually a month ago. The Angolan kwanza, I love to watch the kwanza. It's a telling currency, man. It's at a record low right now, as of Friday. All right, it's over the last 9 years, the dollar is up 755% against the kwanza. Pakistan, since 2008, the Pakistan rupee, which is at a record low on Friday. Literally, this is Saturday. This is Saturday the 26th. Friday. Naira, not Naira. Kwanza, new low. Pakistan, rupee, new low. Okay. Dollar rupee up 400% since 2008. The Indian rupee was just at a new low, just rallied though. The Turkish lira, since 2008. Turkish lira made a new low on Friday. New all-time low. Turkish lira, dollar lira is up 2,368% since 2008. 2,400%. Now you talk about, we know the hryvnia in Ukraine. We know what's going on there. We know what the ruble's doing, okay? There are 2 other major currencies that are big commodity producers, exporters. Okay, Uzbekistan and Kazakhstan. The Uzbekistan som, new low on Friday, new all-time low. Since 2009, dollar is up 730%. The Kazakhstan tenge, always a great currency to watch, really an important currency. For no other reason, that 35% of the world's uranium, I believe it's 35%. Number 1 producer. Tenge, they just cut interest rates because they're worried about the economy, all right? And the tenge, dollar tenge, since 2014, and I did a piece in January on Kazakhstan. It was my special year ahead with several currencies. 2 of them, Kazakhstan tenge and the Argentinian peso. Kazakhstan tenge devalued 5 weeks later, Argentinian peso 2 months later, hugely after I wrote those pieces in the Year Ahead Outlook. 2014 was a good year. But just now they cut rates. Since 2014, dollar tenge is up 240%. And since 2008, the pièce de résistance, the dollar up against the Argentinian peso by 11,000, dollar peso, dollar up 11,533% since 2008. Think about that. Think about the person in Argentina. Used to be 1-to-1. Now it's like, I think, 350. It used to be 3, now it's 350. I mean, it's insanity around the world. So, the Fed is not just affecting just the U.S. labor market, man. It's a little bit short-sighted here, all right? I did a special report on the currency market, too. If you want that by any chance, that's fine. But right now, the timeline I laid out in April is right in line. Summer rally in stocks. You would see a return in inflation on the base effect reversing hard in August. This would timeline perfectly with the analog with 1987 when bond yields kept rising into August when they were expected that, they might not do that. All right. And all of a sudden, 2 months later, you know what happened? The timeline is right on, man. And everything I said back in April is playing out within this timeline. And I said there'd be a reality check. The economy would finally feel the effects. And by the end of September, the economy would be under big pressure. And we would be looking at this as the Wile E. Coyote market. He's already run off the cliff. He just hasn't looked down yet. All right. But this means opportunity. And that's what I want to help you with all the stuff we're doing on the podcast, on the, macro market minute, because that stuff is free and that stuff will help you and, to whatever degree. And then of course, to do the business wise, we also have the ETF playbook. It helps you with your allocations. So, look on YouTube for the, macro market minute. Email me for the free report on currencies and or housing. I did one this week and or one of them, take your pick. Uranium. Okay. We'll give you all our picks in the uranium market. And then find us on Twitter and on Instagram as well, and follow us there. We post a lot of cool stuff. Greg Weldon, another episode in the books. Thank you so much for listening.